Hi, everybody. Welcome. I'm the ETF professor and also co-portfolio manager of Block and lead ETF strategist for the ETF Think Tank. That's a lot to swallow. But that's my background, and then I'm going to cue it up to David. You're up, David.
Yeah, go real quick here. David Chikansky. Good to see you guys all again. I manage the SoFi Be Your Own Boss BYOB ETF, as well as the Amplify Inflation Fighters ETF, as well as some of our SMAs. And I'll kick it over to Cynthia.
Hey guys, I'm Cynthia Murphy, head of research for the Tank. As always, so excited everybody's here. And we have a great guest today, John Davi. John, go ahead and introduce yourself. Tell everybody a little bit about what you do and all the stuff keeps you busy.
Sure. Hey everyone, John Davi. I'm the CEO, CIO of Astoria Portfolio Advisors. We are an asset management company. We sub-advise portfolios for other financial advisors. So basically the crux of what we do is, we'll deliver, kind of like, multi-asset ETF solutions for other financial advisors on behalf of, their end clients. So we manage about 1.3 billion in total assets. Much of what I do is based on my background, which is macro quantitative. So I worked 20 years between Merrill Lynch and Morgan Stanley, building institutional caliber, multi-asset portfolios for institutional investors. So basically I took that skill set and we're now applying it, for, financial advisors and for their own clients. So that's a little bit about who we are and the solutions we build for clients.
So with that, I've kind of tagged you as a bullish guy right now, and I don't know if that's fair. I've struggled, frankly, with being the sole bull on the ETF Think Tank, but I'm glad to have the company with you. So explain, if that's true, and how you view the markets in general right now.
Yeah, absolutely. So first start off by saying that, when we build portfolios, we're looking at the macroeconomic economy. Where are we in the macro cycle? Where are we in the earnings cycle? Where are we in the inflation cycle? And, we'll tilt our portfolios accordingly. So if I go back to like June of 2020, September 2020, we thought that, basically, so much was priced into the stock market. If you remember March 2020, COVID, S&P fell 45%. At that point in time, the summer of 2020, there's a lot of fear mongering, the world was going to end. We just thought that at the end of the day, the Fed, typically what they do is they come in and save the day, and that they would provide a floor to risk assets. So they dropped interest rates lower. They did a bunch of quantitative easing. They bought bonds. They bought mortgage-backed securities. A lot of stimulus was being put into the market, trillions and trillions of dollars. We thought that we would have, a pretty decent earnings cycle and recovery and a pretty big inflation cycle. So, we started, thinking about how to hedge portfolios for this inflation risk. Most portfolios are still built with this like rear view mirror, where a lot of it is like technology and growth. And what we were saying at the time, like June 2020, was tilt your portfolio towards value, hedge for inflation. We thought that would be the major pain point for clients. Fast forward now 2 years later, right? Summer of 2022, we think that theme has sort of played out quite a bit. Most people on Wall Street are very, very bearish, kind of, in a fetal position underneath the desk. And what we're saying is that after the first 3-4 months, when the average stock in the US fell about 30-35%, we think that, on the margin, you should be nibbling on stocks and credit. And that's the operating word for our Q3 outlook. It's to start and to nibble on stocks and credit. I don't think we're going into like some DEFCON 5 recession. I think the stock market has already reflected that. cryptocurrencies, speculative tech stocks repriced that risk early in the year. So we tend to be a lot more constructive. I mean, at the end of the day, like the Fed was very aggressive in hiking interest rates, no doubt, but the stock market, we think, reflected that. Now, we've been rallying now since June 16th. That was kind of the low in the S&P and NASDAQ. And, I think we have like more, a little bit more legs in this rally. We're not tactical. So I just want to make clear that like we're long-term strategic, but we're oftentimes being asked for our opinion, kind of short term. So I think that once you get past like October, that's when like the Fed will start their increasing quantitative tightening. There's a lot of seasonality that's bad in September, October, but we have like a solid month left, I think, of like not too much news that will, kind of derail the market rally. I mean, yes, 2023, like there's more risk because eventually the Fed always kills the recovery. My only point is that the stock market reflected that early in the year when the Fed was like really aggressively, leaning hawkish. So that's a little bit about where we were, where we are, where we think we'll be. So I'll pause there, Dan, and see if there's other questions on that topic.
So, what's your take on fixed income along those same lines? Because at the end of the day, to me, that's always been the biggest indicator of both confidence and economic momentum.
So that's very interesting question, because for years, the last really 4 or 5 years, we've been generally speaking very underweight fixed income. We've been not big fans. Like we tend to use, higher quality fixed income. So, lower quality fixed income tends to be highly correlated with equities. So if you think about, junk bonds, very highly correlated to like small cap stocks. So like our portfolios, for instance, would own equity stocks, higher quality fixed income to kind of hedge our equity risk, and alternatives in order to further dampen our, portfolio volatility. So we've been very underweight for a while. We've been concerned about rising rates for a while, and it's been the right call for this year. But once you start seeing stats like, the worst 6 months for the Barclays index and the history of the index, like we think the bond market has basically priced this rate rise and inflation rise much early in the year. So I think unless you think that there's some big DEFCON 5 recession that's going to start to occur, like we think you should start nibbling on credit. IG bonds, they're marked down 10%, high yield bonds are marked down 15%. You're getting somewhere between 7-8% coupon for owning these things. You can get equity-like returns with a lot less volatility with this credit. So I think that's very attractive. I think for high income earners, munis make a lot of sense. I'd probably avoid mortgage-backed securities because the Fed's going to unwind their balance sheet and they're going to unwind their mortgage-backed securities. Treasuries, we don't really own, just because, I mean, yes, rates went up a lot, but I just think credit, you're being paid to take on that risk if you assume that there's not going to be a recession.
I was actually a little surprised that you said at this point equally equities and credit, right? I think maybe, as you alluded to, like mid-June, yeah, I think that's definitely the case. But I mean, broad US equities are about 2.4% behind ag on the year. And I don't think people really understand that. So I kind of, for me, it's kind of like, does that mean the opportunity lies more on the fixed income side? Or is that just this continued trap in this rising interest rate environment? So what are your thoughts on between equities and fixed? In the quality side, right? You're doing quality on both the IG and equity side. But like, given the spread on the year, and I'll add the next question being like, my biggest concern is like, how do we actually keep earnings next year on this trajectory that we're at? And if that's like the one thing that just hasn't really been repriced at all. And people are like, oh, well, in inflationary environments, you keep up your margins, but like margins were not at this level in those past inflationary environments. They're at all-time highs. So like, how does that stay up? And so back to the first question of like stocks or bonds, very simple.
Well, I think always I prefer stocks over bonds because there's enough of an equity risk premium in stocks. It's well documented, for long-term wealth accumulation, like you're always better to own stocks than any asset class. So that's the whole Jeremy Siegel stocks for the long run. The Dow Jones going back 200 years, the equity risk premium that it gives you. So you always own stocks over any asset classes. Stocks also keep up with the rate of inflation. You get dividends. Dividends tend to be stable. And sometimes like we just can't build a portfolio of 100% equities because that's not too much risk for the financial advisor. So we have to, like, instead of owning 100% equities, which are, let's say, like a 17, 18 standard deviation, you've got to have some bonds in there that kind of lower your standard deviation, lower your drawdowns. So, we'd always lean more on equities than credit. And we would say like a US high quality dividend paying stock at like 14 times earnings, like 14 times P, that absolutely, is a no-brainer to me. The overall S&P is not that expensive. Value stocks, 13, 14 P ratio, international 10, emerging markets 8 P ratio. Like these are opportunities that you just don't see that often. So our point is like the best time to buy stocks is usually in a recession because your margin of safety is widened materially and you're being compensated for taking on that risk, and you're generally speaking rewarded for that risk. So that's kind of where we are in between stocks and credit.
If I'm not mistaken, though, you are quoting on forward earnings, right? So, like, I guess specifically, like, do you anticipate earning levels to be able to keep up in this inflation environment, or like, because that's my biggest concern is like that 14 could be a 17, 18 really quick if things just get adjusted, right? Because of everything. Look, the velocity of money is slowing down. And I think that affects businesses just as much.
So yeah, great point. So earnings, were the big concern going into this earnings season and this rally. So earnings have been hanging in there, and I think that's why we've rallied. Are earnings going to come down, or will they come down if we get like a real bad recession? Absolutely. Like the average earnings decline is like 20% or more during other previous recessions. But I guess we have to define a recession, and how bad is this recession going to be? Like I've always been of the opinion that it would be a mild one, because I thought that corporations and individuals had much better balance sheet. The labor market's super tight. And again, like I still go back to what I said about the Fed pressing their pedal to the metal, and the stocks were very uncomfortable as they were doing that, and they've reflected a lot of this risk. So we had a 25% drawdown for the average stock. Are we going to go down another 25% because we go into an earnings recession? Like that'd be very unusual to have like 25% drawdowns. That would basically imply like two different like recessions, and I just don't see that happening in the next 6 to 9 months, given how tight the labor market is. Our earnings still marked pretty high, like absolutely. But I don't think that it's gonna, that's the risk, to your point, David. Like you buy an S&P at 14, can you buy it at 10 if we go down next year into a big recession? Now you get into like market timing, and
I agree with you in the next 6 to 9 months. I think the problem can like arise around like the discretionary spending of like holiday season and what those numbers will result in. And it's really not just like, can we outpace this year's numbers? Like the forecast for 2023, even before this earnings season, was exceptionally rosy for 2023. Even before earnings showed that they're stabilizing a little bit here. And so my question is just like, can we continue on this pace of growth? And I don't know. We'll see. Not a question statement. Anyone else want to jump in? So.
Yeah, do you want to talk alts, John? Before the call, we were, talking about how actually this has been a great year for you. So, and what I've always loved about you is that you've always been super open about how you're building your portfolios and what you're implementing and ditching at all times. So tell us, what kind of alternatives have you used? How have you positioned to, what factors have you tilted to, and to, the secret to your success this year when we all have been pretty beaten down.
Yeah. So yeah, thank you for the question. And I think like so we can never be 100% sure we're right, which is why like when we build portfolios, we want to have like insurance in case there's a rainy day. So similar to like, you have car insurance, house insurance, life insurance, we think you should have portfolio insurance. You never leave your house without having house insurance. You never get in your car without car insurance. So we just always carry portfolio insurance somewhere around like 15-20%, depending on how much risk is in the portfolio. So sometimes people say alternatives and they say like, high yield bonds, but to me that like adds to your equity risk, right? Because high yield bonds in a recession will go down, 30 to 50%. Sometimes people say REITs are alternatives. I've seen REITs go down 80% in a recession. So you really want to look at like strategies that have very low correlation. So if the S&P is down 20, you want to have strategies that are going to be up, right? So I think Jim Carroll's on the call, and Jim does a lot of vol strategies, and volatility tends to be like inversely correlated, but it's tough to carry because that insurance premium is quite expensive. So what we try and do is like own alternatives that are inversely correlated where you're not paying some like massive premium for it. So, like if your house's insurance is $1,000 and it covers $1 million worth of damage, like, do you want to buy options where it's like $10,000 to carry that $1 million policy, or do you want to buy like $1,000 premium that carries that $1 million home value? So, we use things like BTAL as a long short market neutral. I don't know what it's up right now, but at one point when S&P was down 20, the CTF was up 15. We have some inflation strategies in there that did well this year when the S&P was down 20%. We own like in the past merger arbitrage, which is kind of like it has like an embedded short position in the ETF. So we like that because at a fairly low correlation. Gold and gold equities tend to have low correlations when you look at it very long periods of time. So, in our world, like if you lose less on the way down, then you got less to make up on the way up. So that's kind of our premise, is like protect some of the downside and participate in the upside. So you've got this nice asymmetric up-down capture ratio. So those are some of the tickers we use. If you go on our website, astoriaadvisors.com, we'll have fact sheets or all our strategies, and we list some of the tickers there in terms of what we own. But that's how we think about like portfolio diversification. Even an example before when we were talking, like, some people for their fixed income exposures, they'll use high yield credit. Like, and I mentioned before, high yield credit will go down, 30, 50% in a recession. So our fixed income exposures tend to also be like higher quality, and they won't go down as much when, the broader S&P is down. So we're really looking for like a couple different ways to kind of hedge our downside risk. One is by higher quality bonds. And then, these alternatives that are very low correlated and ideally inversely correlated, where you're not paying a lot of like premium to carry those alternatives.
So John, some people, and there's a question from Warren Kaplan about cash, and Warren, do you want to ask the question? Or you want me to ask? Or just raise your hand if you want to ask. Okay. So Warren and I know each other. Cash to some people is an asset class, and I understand that cash in an SMA or an ETF doesn't look so good. But do you see cash as an alternative? And if so, where do you stand on it, given where inflation is? And cash can be very short duration bonds, is the way I'm defining it.
So we did own more cash than usual going into this year. So there's, you don't want to own tons of cash because you'll still lose out on a purchasing parity perspective. But it certainly helped our portfolios early this year when we owned, very short. So the ag index is like, 7-8 duration. Our portfolio duration was like maybe like 2 or 3. We started increasing that duration in our last rebalance this summer, because we want to, like, as I said, the operating word in our Q3 outlook was start to nibble on stocks and credit. And part of that is like we actually purchased duration. But I mean, cash, I don't think it's, I mean, you're still going to lose to the rate of inflation. But if you're concerned about portfolio, what's going on in the market and all the cross currents, like there used to be a phrase a couple of years ago saying cash is trash. I wouldn't say cash is trash anymore, because you
No.
can go out and buy, and this is what we started doing for some clients, is like we'll go out and buy like 1-year treasury bond, and we'll do these like laddered bond portfolios, like 6-month treasuries, 1-year treasury, 2-year treasury. We'll sprinkle in some IG corporate bonds, like fixed maturities. So, you're getting now some, your yield to maturity is attractive, and B, you're utilizing some of that cash, right? So, I mean, it's not going to be reflected in your money market account or in your, I don't know, your Chase savings account just yet. But if you go out and buy fixed maturity bonds, it's something that we just hadn't done in the last 4 or 5 years, and we started doing it this year. So I would be looking to put that cash to work if it fits your risk profile, Warren. But that's, for years and years, right? We'd have investors say, look, I'm not getting anything at the bank, so I'm going to go out and buy stocks. And I'm like, whoa, that's very risky. Like the bank, it's risk free. You're not getting any yield on it, but you're not taking any risk. Now, the minute you want to go to the stock market, you're taking a lot of risk. So, now like you're starting to see, what I think investors that didn't want to, take on all the risk in the stock market, I think you can kind of pare that back and now look at these like laddered bond solutions.
So
There's a question from Michael.
yeah,
Michael, go
Michael,
for it. Yeah.
go for it.
Okay, thanks. So my first question was regarding alternatives, but you already asked that question and answered that. So my next question was regarding allocation. So beginning of the year, what was your allocation? What is it now? How much have you changed it since the start of the year?
So we have like a lot of different solutions, Michael. Like we've got, stock portfolios, we've got ETF portfolios. I'll just give you like our bread and butter, which is like our multi-asset ETF portfolios, like, kind of a balanced 60-40. So the truth is that we didn't do much trading this year at all, because we built the portfolio for this year. We did it last year. So last year we were short duration. We owned a lot of cash. We had those inflation hedges. We had those alternatives. So we kind of went into this year knowing that this inflation theme would play out. This rotation to value would go on. We'd have trouble, with inflation rising and rates rising. So in July, what we started doing is taking some of the excess cash we had in our portfolios and nibbling on, credit. And it's like IG credit, a little bit of like high yield credit. So we funded like the purchase of credit with our cash position. That's kind of like the big picture notable thing we did in our portfolio. We still have like a lot of inflation hedges. We still are leaning on a quality factor. So we tend to lean on like DGRW. We've had it in our portfolio, really in the last 4 or 5 years. At one point this year, DGRW was down 10, the S&P was down 20. So that's a great relative outperformance. And, when things get real squirrely in the market and there's a lot of volatility, people tend to gravitate towards high quality stocks and dividend paying stocks. So something like DGRW has done pretty well this year. Things like SDY, DVY, SPY-D, these are all solutions that we've leaned on in a number of our portfolios.
Okay, thank you.
How much consideration do you give to taxes these days, John?
So taxes matter a lot for our financial advisors and for their end clients. You know, we do this like systematic tax loss harvesting. So the great thing about ETFs that I just mentioned DGRW, and there's going to be like another 2 or 3 alternatives that are very closely correlated to DGRW. So when you've got this downturn in the market, you know, you can kind of rotate out of DGRW into something very highly correlated, and that's a way to like harvest your losses. I mean, obviously talk to a financial advice, a tax professional. This is not tax advice, but tax loss harvesting is a pretty well-known thing. I think this is a year where, you know, you're starting to see a lot of that. You know, what we try and advocate for is not wait till the end of the year, because like we could rally now from now till the end of the year, and you would have lost that opportunity to harvest your losses. But we tend to be very, very mindful of taxes when building portfolios and we're rebalancing.
Thanks for saying the word rally. I was getting thirsty over here.
Yeah, ask what would
Go, David.
yeah, so I know you might not allocate to like broader growth because you're a little more factor based, so maybe like growth or momentum. But what would it take for you to allocate in that direction? And what are you waiting for?
So here's yeah. So you're asking me like rotating back into growth out of value. Is that the idea? I mean, you know, it's funny, like value is very cyclical. It works when profits are rising and expanding, when you're in the early stages of the recovery. So if you think about what I said earlier on, like in, you know, the mid 2020, we were buying value, preparing for this inflation. You know, that theme is kind of largely played out. Now, as you've alluded to correctly, you know, the profit cycle may be deteriorating, earnings may come down. And basically, you know, the stock market is very smart, right? The NASDAQ is now up 20% since June 16th, right? So the market is basically telling us that, I believe, that this rotation out of value into growth has like some legs to it, and that earnings are high and they have to come down. So, you know, in a multi-asset portfolio, it's good to have a lot of different factors, because any given time in any given year, one could do better than the other. We're heavy in quality because quality is just this factor that's, you know, persistent, pervasive, robust. It's easy to explain, you know, generally always works. So I think this rotation, you know, from value to growth is kind of going to continue on, especially as we get longer in the tooth in this recovery. And then there'll be another cycle, and then value will then outperform again, like when we have another recession. So it's just tough to time these transitions, but you're starting to see that, David. Like, you know, NASDAQ is now rallying. So again, I mean, they're both rallying, but definitely growth is outperforming value on a relative basis. And it's been going on actually now, not just June 16th. I just kind of picked the low in the market, but it's been going on for a couple months. So I think the market is telling us that, you know, there's some trouble ahead for value stocks. The only problem I have with that, David, is that value stocks are just uber cheap, especially if you're going like oil and gas exploration and materials. Are you talking about like a 5-6 P ratio? You know, growth is still very expensive, right? On an absolute basis, on a relative basis. So that's the problem with this like full reversal out of value into growth, is that growth is still very expensive versus history.
I'm going to cut Dan Weisskopf off, which she loves when I do, jump back in for another question. And say, honestly, I completely agree with you, but I guess I would like at least a couple weeks ago, especially with oil taking the drawdown with everything else. I think that the pair does really well. You get those commodity producers, you get some high flyers, and do what you guys clearly do very well, and rebalance between those and your alts, et cetera. So, but yeah, awesome stuff. Dan, sorry. Your floor.
Totally cool. So, you know how structure matters, of course, and Apple is a stock that some people consider growth, some people consider value. How do you treat a stock like that is in the S&P and across so many different indexes? Do you isolate it? And then secondly, because I'm going to cheat and ask 2 questions at the same time and cut David off. How do you feel about the single stock ETFs? Stole your question, David.
I think single stock ETFs are going to be very tough unless you're day trading, unless you're like just making a quick, short-term tactical bet on, Tesla or Pfizer, whatever it is. But for anyone that's building a portfolio for the long run, there's just no need for it. But listen, there's a lot of people out there that day trade stocks, that day trade lotto, penny stocks, OTC stocks, that day trade options. I mean, some of that is actually starting to come down. If you think about like Robinhood and, some of these platforms, I think early on in the pandemic, there was a lot of stimulus and a lot of people gambling because they couldn't go out. But after now the world opened up, COVID is, kind of, lesser of a risk now than 2 years ago. And now the stock market's gone down quite significantly. I think there's less appetite for those type of trades, but listen, I never thought triple leverage.
Options from retail is still pretty high though. Like options volume in general from retail is still quite high.
Yeah. I never thought triple levered ETFs and oil and gas or VIX would ever really raise assets. But what I've learned is that there's always a market for something. And, the marketing machines of some of these issuers are very impressive. So I personally would never use a single stock ETF, especially if there's leverage. Just not a need for us at Astoria, but I'm pulling for the guys that are issuing it because, I think it's something very unique for sure.
Jen, we have some audience questions. Should we pull some people up? I mean, the next one I think was Eric, but he either fell off a boat or something happened on his screen. So maybe we can bring up Ray.
Okay, Ray, I missed you. Sorry, man.
No, good. Thanks, y'all. And again, thanks for putting these on. And thank you, John. A couple questions. One for your alternative exposure is it, and I haven't looked at the fact sheets and all enough. Do you limit it just to ETFs, or do you look at it differently? Or there other vehicles, mutual funds, different kind of direct investments you might use? And a second question, completely unrelated, is any opinion on what in the world is going on with the government bonds? I noticed that over the last couple of days, we've had another 20 basis point swing in the 10-year, and that used to be unusual. It doesn't seem like it is. And yeah, there was a research piece out I read today was talking about liquidity, that there should be a ton, but maybe there's not. Or any thoughts on that from a macro perspective? Thanks.
So for alternatives, my advice is like, just 25 years of being around, the markets and whatnot. I mean, the word alternative, it could be a very complex thing. Like, are you talking about things that are low correlated, inversely correlated? Are you getting equity-like risk and return, but just don't have the daily mark-to-market issues like a stock? I think I'm not a big believer in liquid alts, like non-exchange traded liquid alts, like, because I think ultimately the way you're getting that exposures through either some type of leverage or risk, like with, either through stocks or leverage swaps. I'm just not a fan. I don't think they've ever really panned out. I see people do non-traded REITs. I think that's a disaster. Quarterly redemptions, you got to wait in line to get your redemption. Like, hedge funds, I think, are very smart. They're very good if you can get exposure to like the big ones. But, your average hedge fund, I think, is just basically correlated to the S&P. It's just a lot of stats. And, there's a lot of just data showing that the average hedge fund just gives you beta-like return, but comes at a very expensive wrapper. So, for what we do, like the BTAL, the M&A, the inflation ETF, like these are things that are cheap. You can trade on an exchange, less than 1% ish management fee, and we've used them and they've done wonders for our portfolios. So that's that question. And then what's going on with bonds? I just think bonds are going to struggle as you have rising rates and high inflation. Now, that's just a comment I'm making, and I'm telling you that we're going on buying like 6-month treasury bonds, 1-year treasury bonds, which is fine, because in 1 year when that rolls off, like we may do something different with that client's account and the money in that account. But I'd be careful buying like treasury ETFs or mutual funds, because you just don't know where rates, if they're going to go to like, I think the Fed's going to keep on hiking rates, and I just don't know where the top is on the 10-year. So
Wait, so you just said something pretty important here. You're constructive on your portfolio. Are you thinking 50, 75, or 25, 25, 75? What I'm going to pin you down, dude. I'm sorry. What's your Fed forecast on what they're doing? Because to me, that's almost the most important question. Nobody has a crystal ball, but that's like the most important question these days.
I think the Fed had to do like a dovish, meeting recently, like a dovish hike, just because like, there was so much pressure that they put on stocks and bonds early in the year. So I think after a lot of the carnage that happened, they had to like in July kind of give a dovish hike, and they pivoted, in my opinion, because they acknowledged that some of the forward-looking inflation indicators were, if you think about oil's down 20% from the highs, gasoline's down 20%, the M2 velocity of money's down significantly, like real estate has softened, right? Mortgage rates have doubled, so the housing market has cooled off. So they don't really need to press as hard as they were early in the year. So my view is they probably, should go 50 and then pause. But, knowing them, like they'll probably do 50 like they'll probably do a hawkish hike in September, because I think this market's going to rally. And the more the market rallies, and the more incentive they have to just keep on hiking rates and bring in inflation. Because the problem with inflation is that, like, once a genie comes out of the bottle, it's really hard to put back. If you look in the 70s, like CPI stayed above, 7% for 10 years, right? So this idea that we're going to go back to 2-3% is just nonsense. Like, it's the same thing that the Fed said when inflation wasn't transitory. Like, they're not going to be able to get inflation down to 2-3% because there's just so much demand, and investors are so fundamentally sound from like a corporate balance sheet perspective. Like, anywhere I look in the East Coast in the month of like May, June, July, like there's people are out spending money left and right. Like, what recession do you see that's imminent? Like, there is none. So now with the market rallying, that gives the Fed another reason to kind of keep, doing more hawkish hikes. So I expect 50 with them intending to kind of go more in the fall. And that's where the bears would argue that that's what they're alluding to, is like, because the more they hike, like the greater the risk of recession, because the Fed usually does always kill the recession. So.
Yeah, and I think the markets are pricing in about 100 more bips on the year. My question is more on the balance sheet, which they haven't really started selling, if I'm not mistaken. They've just stopped buying and allowed to start rolling off. But the serious selling is supposed to start, I believe, next month. Which, if you recall, the last time we tried to lower the balance sheet, that's what really kind of started rocking markets and overnight rates in banking markets. So like, what are your thoughts on the balance sheet? I think I do think like the market's almost giving them a green light to get at least another 50, if not 100 basis points on the year. But like, what do you think about the balance sheet? Are they going to actually be able to unwind it? And what are the ramifications if they can't, because the market then starts responding poorly?
It's funny because I don't see the need why they need to like unwind it. Like, who cares? Like, wait until next year. Like, I just don't see, like, the market doesn't like when the Fed hikes rates and unwinds their balance sheet. Like, we tried it in 2018 and the market fell apart, 20% in like 3 weeks, right? That's like the Christmas Eve massacre when the market fell like 3.5% on Christmas Eve. I just don't see the point. Like, why? Like, you've had it this long for, since 2008, you've dramatically expanded the balance sheet. Like, I get that you got to eventually do it, but I would just take steps like hike rates 1 year, and then maybe when things are better, like then you unwind the balance sheet. So I think that's the biggest risk, David, is that, nobody's talking about the Fed, doing their quantitative tightening or increasing the quantitative tightening. And I think that's probably where the market gets a little wonky. And I think the timeline is somewhere around September, October, where they increase the threshold. So that's my expectation for like when things start to like revert. So I think a lot of this rally starts to fizzle, come September, October. And again, just to be clear, like we don't build portfolios this way. We're not tactical, but people ask me for, a very tactical opinion, and that's what I'd have to say to them.
I think quantitative tightening might just take up too many characters and tweet. Who knows? But I kind of agree that they're going to definitely undercut the trimming of the portfolio. I do agree it's very, very necessary long term. I don't know if we'll ever get to it. If I think as long as we don't creep further towards Japan, that might be enough to sustain some semblance of dollar power. But I just like outside of, and this will be a record 43 minutes in before someone mentions crypto, but like outside of crypto, like what else is the asset class that when the market realizes, as it seems like we agree, that like they will not unwind this balance sheet, right? So what is the play there? Is it crypto? If not, what else is it?
I'm not a big fan of crypto, I'll be honest with you.
So what's the other play?
I just never really got it.
There is a play there, right?
What's the other call?
I don't know. Sorry. Yeah, well, how do you like?
I'm
How do
losing
you
you a little
like
bit.
if you think that's the case? What's like? How do you defend it?
I don't know if anyone else is having trouble hearing David.
Listen, I had trouble hearing him too. John, this has been great, and I know you got to run to a trip. We appreciate the time, appreciate the insights. Remind everybody how they can find more information about you and Michael.
Sure. So if you go to
Magda,
Astoria,
yeah.
go to AstoriaAdvisors.com, or you can follow me on Twitter at Astoria Advisors. So
Awesome,
appreciate
everybody. We're
everyone's
gonna,
time.
yeah, John's got to run it. You're going to a bake sale or something fun like that with his kids. So we're not going to keep him. We're going to let him run. Thank you so much for joining us, John.
I grew up in Queens, Cynthia, playing
Yeah.
stickball and stoop ball, and my kids are growing up in the suburbs and they're doing sailing and tennis. So, good life for them.
Yeah, very good. Very good.
In case
So
you
go
can't tell
enjoy.
from my Queens accent,
Thanks everyone for joining us. As always a pleasure to see everybody. Thanks for the questions, and hope market keeps rallying for us, and have a great weekend. We'll see you all next week.
Thank you.
Bye.